Hey everybody, in today's video, we're going to be tackling a key challenge for companies administering equity compensation. And that is, how do you properly manage FICA taxes on retirement eligible RSUs? And now this issue is a complex but critical one because if you do get it wrong, it can lead to some serious compliance issues. So let's go ahead and dive right into it. Now, first off, let's go ahead and look at the problem. Let's talk about what happens when an employee does become retirement eligible, because this concept is where things do get tricky. Because normally, when an employee receives RSUs, they are going to vest over time, meaning that the employee doesn't have access to the shares immediately. However, the timing of FICA taxes, they aren't tied to when the shares are delivered. It's tied to when the risk of forfeiture is removed. And this means that once an employee reaches a point where they won't lose the shares, like for instance, when they become retirement eligible, this is when the clock starts ticking for FICA. And I want to share with you guys a great example that was discussed in our recent NASPP webinar, Understanding the Administrative Impact of Retirement Provisions. Now, in this scenario, let's suppose you have an employee that has a 3-year cliff period for RSUs, but this employee becomes eligible to retire halfway through that period. And even though they won't get the shares until the end of the 3 years, FICA taxes are due as soon as they hit that retirement eligibility mark. And this is what we call a dry tax charge. So in other words, the employee owes taxes on income they actually haven't received yet, because in the eyes of the IRS, there's no longer a substantial risk of forfeiture. Now, this dry tax issue, it creates a challenge for both companies and employees. The RSUs haven't vested yet, but the tax is due because the IRS considers the income to have been earned once the risk of losing the shares has dissipated. And as I learned in the webinar, companies often struggle with how to manage this. Do they withhold taxes from the employee's salary? Do they require a personal payment or accelerate a portion of the shares to cover the tax bill? What is the solution here? Well, each option is going to have its own challenges. For instance, when you accelerate shares, it might seem like an easy solution, but it can create inconsistencies with how other employees are treated, especially if they're not retirement eligible yet. A personal payment from the employee might be too costly for them and probably isn't going to go over well. And alternatively, withholding from an employee's regular paycheck might not actually cover the full tax burden if the equity award is substantial. So, what is the solution here? Well, it comes down to proactive planning. As the experts in the webinar highlighted, you need to monitor each employee's retirement eligibility closely. The moment an employee hits that threshold, FICA taxes are due, and if you wait until the shares are fully vested or delivered, you're out of compliance, which does mean you're on the hook for not only back taxes, but potential penalties and interest. And that's not a risk any company wants to take. But the good news is there are steps that you can take right now to avoid these issues. In the webinar that was mentioned earlier, Understanding the Administrative Impact of Retirement Provisions, Sharman and Lexi are going to give you the playbook on how to do this the right way. So again, thank you for everyone who has joined us till the end of this video. I hope you enjoyed it. And if you did, don't forget to like the video and maybe share it with someone you think could benefit from this information. So again, thank you all, and I hope to see you all in the next one.